Now let's bring in one of Bloomberg's most accurate economists, Michael Moran, chief economist at Daiwa Capital Markets. He's a Bloomberg Best, and he's also a former Federal Reserve economist. Mr. Moran, welcome to Bottom Line. Thanks for coming on.
Thank you, Mark. Good to be here.
You just heard my colleague Michael McKee. One thing that jumped out at me, the minutes showing two members argued for additional, stronger easing. Did that catch you by surprise?
Well, the fact that two of them voted for that or preferred that was a little bit surprising. It's not surprising that at least one did. There's one Fed official who Mike mentioned, Charles Evans in Chicago, who's been arguing strongly for additional easing and forceful action from the Federal Reserve. So it's not surprising that he was in that camp. The fact that he brought someone else along with him is mildly surprising, although there are other officials who have spoken forcefully. For example, Eric Rosengren from the Boston Fed has also been very much on the dovish side, or preferring to do more action. Bill Dudley at the New York Fed has very actively been arguing for aggressive Fed actions.
But what we can take away from these meetings is that QE3, or a possibility of it, has not been taken off the table.
It has not been taken off the table, but I would still say there's a high hurdle for QE3. As Mike mentioned in his review, I think most FOMC members are going to view that as a tool that should be reserved for if the economy were to start to decline, or if we were to get into a situation where deflation is a risk. And right now I don't see that happening. So I think it's there, it's possible, but it's a high hurdle.
Talk to me about Operation Twist. We're a few weeks away from that. How has that worked out so far?
Operation Twist is underway. They started at the beginning of October. I think it's had an effect. There was an anticipatory effect. You started to see long-term interest rates move lower during the month of September because there were thoughts and rumors around that the Fed would do Operation Twist, and rates moved down ahead of that. Since they have started, there really has not been that much additional move. But again, I think it has had an effect. It just happened before the fact, in anticipation of the Fed doing this.
Talk to me about the specter of inflation and how that might be driving the discussion among policymakers.
Well, there's really no immediate threat of inflation, but I think the thought among some policymakers is if you leave the stance that they have in place right now for a long period, for an extended period, that you would develop some type of dislocations in the economy that would translate into either a bubble in some asset market or overall inflation. In fact, you could argue that we saw that in the early part of the 2000s, that the Fed was easy for a long period of time, and that laid the foundation or contributed to the housing bubble. I think some Fed officials are worried about a similar situation this time.
And we also have one of our headlines that some officials, at least some of the Fed officials, they said that contacts reported that loan demand was weak. How does that change the dynamic?
Well, loan demand you could view as a driving force for the economy or an indicator of underlying conditions in the economy. If activity were brisk, you'd see loan demand strong. We are not seeing that right now. I would mention, though, that we're starting to see shifts on that front. If you look back in 2009, 2010, in the early part of this year, we were seeing loan volume at banks decline. In the past few months, though, we've seen loans growing at commercial banks. So there is some stirring, some little pickup in both the demand for loans by businesses and consumers and willingness by banks to lend.
As Michael mentioned, the policymakers, they did rule out recession, but they did also downgrade their economic forecast. How does that bode between now and the end of the year and as we go into 2012, which is an election year?
Right. Well, this was back in September. They were looking at numbers for August, and if you look at the more recent numbers that we've seen, they've been a little bit better than what we saw before. So I think it reinforces their view that we're going to avoid recession. Even though the numbers have looked better, they have not looked strong. So instead of the economy just barely growing, it's just going to be limping along. I would say a growth rate of 1.5% to 2% seems to be where we are right now. In the first half of the year, we were less than 1%. So we're better, but still not doing real well.
I got to ask you quickly, did you get a chance to watch the presidential debate last night?
Yeah, unfortunately, I did not get to see that. I'm very sorry.
No, that's okay, because we've been asking some of our guests if they'd like to comment on that. But even going forward, prior to the debate, it's been this dynamic going on between the Fed, between Congress and the White House. What do the American people need to hear from Fed officials and from policymakers going forward about how to right this ship?
Well, unfortunately, there's been a lot of presidential candidates trying to beat up the Fed and criticize the Fed.
We heard it last night, too.
I think they are off base in those criticisms. The Fed, I think, has done a stellar job and has done a lot to keep the economy on track. I think what needs to be done is have the fiscal situation clarified, both the
Yes.
outlook for taxes and entitlement programs.
Michael Moran, Chief Economist, Daiwa Capital Markets, joining us. Mr. Moran, thanks so much for your time. We appreciate it.
My pleasure, Mark.